Tonight on NewsXstreem, a clash of power at the highest levels of government. President Donald Trump is turning up the heat on Federal Reserve Chair Jerome Powell, igniting a fierce debate over the future of U.S. monetary policy and the independence of federal institutions. Is this just political theater, or the start of something far more consequential for our economy and democracy? Let's break it down. President Trump took to social media Thursday morning to launch a blistering attack on Fed Chair Jerome Powell, calling for his termination and accusing him of being too late and wrong in addressing interest rate cuts. Just one day earlier, Powell sounded the alarm during an event in Chicago. He described Trump's aggressive trade policies, particularly sweeping tariffs, as unprecedented, and warned that these actions are steering the economy into uncharted waters. As the U.S. faces internal monetary pressure,
given us maximum employment and stable prices. Despite heightened uncertainty and downside risks, the U.S. economy is still in a solid position. The labor market is at or near maximum employment. Inflation has come down a great deal, but is still running a bit above our 2% objective. Turning briefly to the incoming data, we'll get the initial reading on first quarter GDP in a couple of weeks. The data we have in hand so far suggests that growth has slowed in the first quarter of this year from last year's solid pace. Despite strong motor vehicle sales, overall consumer spending appears to have grown modestly. In addition, strong imports during the first quarter, reflecting attempts to get ahead of potential tariffs, are expected to weigh on GDP growth. Surveys of households and businesses report a sharp decline in sentiment and elevated uncertainty about the outlook, largely reflecting trade policy concerns. Outside forecasts for the full year are coming down and, for the most part, point to continued slowing but still positive growth. We are closely tracking incoming data as households and businesses continue to digest these developments. In the labor market, during the first 3 months of this year, non-farm payrolls grew by an average of 150,000 jobs per month. While job growth has slowed relative to last year, the combination of low layoffs and lower labor force growth has kept the unemployment rate in the low and stable range. Meanwhile, the ratio of job openings to unemployed job seekers has remained just above 1, near its pre-pandemic level. Wage growth has continued to moderate while still outpacing inflation. Overall, the labor market appears to be in solid condition and broadly in balance, and is not a significant source of inflationary pressure. As for our price stability mandate, inflation has significantly eased from its pandemic highs of mid-2022, without the kind of painful rise in unemployment that has frequently accompanied efforts to bring down high inflation. Progress on inflation continues at a gradual pace, and recent readings remain above our 2% objective. Estimates based on the most recent data from last week show that total headline PCE prices rose 2.3% over the 12 months ending in March, and that excluding the volatile food and energy categories, core prices rose 2.6%. Looking forward, the new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. These policies are still evolving, and their effects on the economy remain highly uncertain. As we learn more, we will continue to update our assessment. The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth. Both survey and market-based measures of near-term inflation expectations have moved up significantly, with survey participants pointing to tariffs. Survey measures of longer-term inflation expectations, for the most part, appear to remain well anchored as well. Market-based break-evens continue to run close to 2%. So, as we gain a better understanding of the policy changes, we'll have a better sense of the implications for the economy and hence for monetary policy. Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close.
The U.S. faces internal monetary pressure. The European Central Bank, ECB, announced its 7th rate cut this year. Wealthy investors, including Ray Dalio, are also voicing concern, not just about Powell's leadership, but the broader instability caused by Trump's tariff-driven strategy. Dalio and others argue this economic tug-of-war could trigger inflation and job losses. Appointed by Trump in 2018, Powell has frequently found himself in the president's crosshairs. In 2019, Trump labeled him the enemy. In 2020, Trump questioned whether he had the legal right to fire Powell. Most recently, Trump indicated he won't reappoint Powell, though he'd let him finish his term. If he's doing the right thing, technically, no. Under current U.S. law, the president cannot unilaterally remove the Fed chair. The Federal Reserve is designed as an independent institution to shield it from political influence. Powell himself has stated firmly that he intends to serve out his term until May 2026. However, Trump's recent actions muddy the waters. He's already dismissed Democratic members of the Federal Trade Commission, National Labor Relations Board, and National Credit Union Administration. These firings challenge the precedent set in the 1935 Supreme Court case Humphreys Executor versus United States, which ruled that presidents cannot fire certain agency officials without cause. Now, even Chief Justice John Roberts is calling for legal briefs as the courts reevaluate the president's power to remove independent regulators. What we're witnessing isn't just a dispute over interest rates, it's a battle over the very structure of American governance. The Fed chair, once untouchable, can be ousted for not aligning with a political agenda. What happens to the checks and balances that underpin our financial system? As the courts prepare to weigh in, one thing is certain: stakes have never been higher. Here at NewsXstreem, we'll be following every twist and turn of this evolving political and economic drama. Stay with us.